Tesla Armageddon. Musk's empire is entering a bear market. The Magnificent Seven is leading the market rout. Are the giants falling finally? We will look at consumer discretionary, which is also very close to a bear market. Is this a buying opportunities or should we just get out? Also, Treasury is approaching Treasury note yield. 30-year Treasury bond yield is approaching 19-year high. This is a bloodbath for bonds. And we'll finish up with dollar, which I think is finally done with its correcting action and might actually go to new 52-week highs, which probably will crush precious metals. All this and more in today's edition of MasterChartsTrading.com market recap for, well, it's already Saturday, July 25th, but I labeled it as Friday. Don't forget to like, share, and comment on this video. Even put a thumbs up in the comment section. This is what keeps this channel going and makes this video more accessible to others. Please do it right now before I get upset. If you are a subscriber, stay tuned. We'll be covering, this is going to be quite a busy members only video. Bitcoin, market breadths, British pound, crude oil are all going to be in the members only video this week. Some of the large cap stocks also will be covered, as well as some of the speculative securities as well. So stay tuned. Throughout the presentation I'll be using my proprietary MasterChartsTrading.com price action indicators, which you can find on my website at MasterChartsTrading.com, and there is a link in the description which you could follow. Okay, I forgot to mention the high yield bonds, but here they are. Let's just start with high yield bonds. So high yield bonds, first, why do I care about high yield bonds? Let's look at the longer term view of high yield bonds and why we should care. Okay, so down below here is a correlation coefficient between, this is junk, high yield bonds, JNK. There's a correlation coefficient between high yield bonds and S&P 500. I've shown this chart on numerous occasions, but I want to reiterate that high yield bonds correlate highly to the S&P 500. In other words, most of the time, or vast majority of the time, high yield bonds are doing the same thing stocks are doing. So right this instant, if we look at the daily time frame, so each candlestick is a day's worth of activity, high yield bonds hit records on 6th of July, but then pretty sharply sold off. In fact, they sold off in a manner which is what's called a divergent manner. So high yield bonds sold off before S&P 500. Now S&P 500 has actually caught up with high yield bonds, and notice that they're next to this green support resistance line. Again, these are my indicators that are available for tradingview.com. So if you need my indicators, go to MasterChartsTrading.com. So if we look at high yield bonds, you can see that there is a stronger move to the downside versus S&P 500, but on Friday here we caught up, and S&P 500 is also now at the green support resistance line. Also notice that S&P did not hit records recently. The last time it hit records was on 2nd of June. High yield bonds did hit records recently, but sold off. So the way I'm reading this chart, we're seeing definitely some sort of trouble in the stock market universe. It's kind of easy to pin it all on the war in Iran, but it's always difficult to attribute causes for why stocks are doing one thing or another. Many times I've seen just spectacular blockbuster earnings and then stock dropped, and vice versa. We saw something different, like sometimes stocks, the earnings are terrible and stocks rallies. So I kind of gave up on trying to say why are we seeing this certain action, and more concentrate on what and when and how. So what are we doing and how are we doing it? So for now we're seeing high yield bonds lead stocks to the downside. S&P 500 basically traded sideways. We can also look at the 4-hour chart for S&P 500. Here is the 4-hour chart, right there. So looking at this chart, we can see that if we were using my indicators, and these are futures, S&P 500 futures, so if we were trading using my indicators, we would buy every time we close above the blue line, and we would have been pretty successful. The last time, notice we touched this red support resistance line, and again, they are not, these are calculated, they're not drawn post factum. So notice that back here in June, it touched this red support resistance line on several occasions and then rallied. So we're seeing something similar, possibly. We haven't actually touched the red support resistance line, but the way this action unfolded, especially at the last 4 hours of last week, this is not a bullish action. I think we will at the very least retest this critical, I labeled this critical support. Remember, this is a 4-hour chart, so each candlestick is 4 hours worth of activity. It's not as meaningful as daily charts, so each candlestick here is a day's worth of activity. But at 4-hour chart, I think there is almost a guarantee we were going to retest this red support resistance line around 7,372. I'm reading it right off the chart. These are the indicators again. If we don't hold here, then it's almost again a guarantee that we will take a trip down to the yellow support resistance line. So let's say we don't hold at 7,000. So from today's price levels, that's another 1.6%. So it doesn't seem like a lot. So that would put us around 7,200 or 7,300 rather. So we can look on the daily chart and see where that takes us from today's price levels around here. Now, yeah, those are pretty good levels. For example, this is a previous low here from 9th of June. And yeah, that's entirely possible. We might just hold here and then rally. Or we could continue lower. There's no way to tell. So for my taste, whenever we're still technically speaking in the bull market, although I will start making case for a potential bear market for at least certain sectors. And I will get to them in a few seconds, and certain stocks for sure. Overall, the stock market is still in a bull phase, so we were thinking about buying. So let's say S&P 500 does decide to drop significantly, like for example towards this blue support resistance line, which would mean from today's price level around another 5%. Not a lot, but that would make it at the very least somewhat oversold, and that would be at least a potential buying opportunity. Right this instant I don't want to buy it because it's definitely overextended still to the upside and not yet oversold enough for me to be interested. So I'm holding my old positions, like for example I have still QQQ NASDAQ that I bought in May of 2025, so over a year ago. I'm still holding half of my position, but if QQQ NASDAQ gets to 673, I would exit my position with a hefty profit, obviously. So as far as the general market is concerned, we're not yet in horrendous danger. So let's look at some other sectors, namely technology of various sorts, and here is the one that is magnificent. 7 of the United States stock market: Google, Apple, Amazon, Nvidia, Tesla, Microsoft, and Facebook Meta. So yesterday, or rather it was actually Thursday, we saw this gigantic gap between Wednesday and Thursday for these stocks. This is a significant gap. It was a 3% gap for this ETF. I mean, again, right this instant, we're technically saying that this is oversold, and we're waiting for a bounce to buy again. So, as in, for example, we did before. For example, here we came down from record highs, made a low below this blue support resistance line, and then a close above it, and that's our signal to buy. Another opportunity was a few days later, for example, here on 1st of July. Right now, because of this gap, I mean, the gap does tend to get filled. People want to buy, or rather, the gaps just tend to get filled one way or another. But we don't know when. So if this continues, then I think a retest of this red support resistance line is quite likely. And then, next week, I guess we will see where this leads us. The fact that, these are Magnificent Seven biggest and, baddest technology companies are kind of under significant pressure is definitely not a good sign, because technology does account for a large percentage of S&P 500. Namely, within the sector, Tesla and to a lesser extent Facebook Meta is definitely underperforming, so we'll look at Tesla most likely next. Yes. So Tesla is definitely already in a bear market. So whenever a stock closes below this yellow support resistance line, it implies a bear market for stocks, for that particular stock. So Tesla has indeed closed below this line. Now we're seeing this is basically a bear market for this particular stock, for Tesla. So even though we have this gap, there is a possibility, of course, that this gap will get filled. If it does get filled, and Tesla actually reaches this red support resistance line, again, technically we could think about selling it short around 373 once this top-in pattern unfolds. So how would the top-in pattern look? Well, we can try to put in a ghost feed, so something maybe like that. And then maybe we'll reach this red support resistance line and then close below it. So that would be the signal for us to sell it. Obviously it hasn't happened yet, but if it does happen, we will be thinking about selling it. Unless something happens and we continue higher and actually close above the blue line, in which case we will this whole bear market idea for Tesla will be negated. But the fact that it is even there, and this is the first time in a while, actually, let me go back how far. So the last time Tesla has been in a bear market was in 2024, and then we see a breakout. So the fact that it's happening at all is definitely not a good sign. So whatever the market forces are, forcing this event, we are paying attention to them. So one of the biggest stocks, obviously one of the members of Magnificent Seven, Meta also is sort of doing the same thing. Basically it entered bear market here. Rally didn't really quite get to the blue support resistance line, and then again collapsed. So technically speaking, again, Meta also has a short signal. And then there's earnings coming up, so we'll see what happens. It could just collapse also. Okay, another one we're looking at pretty carefully is XLY, so consumer discretionary sector. Within it, of course, we see Tesla, and McDonald's and Nike and let me see what else is in here that is already in the bear market. So Tesla for sure, I just showed it to you. McDonald's, yes, also, I mean, that's a bear market right there, which entered on May 1st. And another one is Nike, also in a bear market, entered back in March of this year. So consumer discretionary are, you know, truly the driver of United States economy. You know, if consumers are not spending, then economy is not doing well. I mean, of course, Amazon accounts for, you know, a quarter of commerce here, but other companies also matter. So we're paying attention to this as well. So if XLY enters a bear market, consumer discretionary, it will be the second major S&P 500 sector to enter a bear market, with first one being XLC, which is communication services sector. Within it, of course, we see Meta, Facebook as a huge driver, but Disney also, and Netflix. So Disney is already in a bear market. You can see it below the yellow line, and Netflix as well. You can see it entered bear market right there. Actually, even earlier, it entered bear market back in January of this year. So this is a very important, XLC. This is a very important sector as well, communication services. So we're seeing, you know, more than one sector enter a bear, or at least get one of them is already in a bear market, XLC, communication services. The other, XLY, which is consumer discretionary, is super close to a bear market. So this is not, not to be ignored. This is important to watch. If this indeed transpires and we see two major sectors in a bear market, we should be now contemplating the entire stock market turning around and entering a bear market. It hasn't obviously happened. You know, you can see S&P 500 is still way up here because there is still a lot of stocks within it that are still doing pretty well, but perhaps we're seeing already, you know, first canaries in the coal mine that are showing us that not everything is all good and well. Looking at long-dated Treasury bonds now, TLT, you can see that Treasury bonds also have entered the bear market. And if we look actually on a 30-year Treasury bond yield, then that picture looks even worse. Not only bear market for long-dated Treasury bonds, but a huge bull run for bond yield. So we're currently at 30-year bond yield at like 5.19, 5.16%. That's a 19-year, approaching 19-year high. So previous highs of this nature were back in 2007. So yes, actually close to 20 now. 19-year high. So, you know, not a good sign. We're seeing, you know, double whammy. We're seeing technology stocks drop and interest rates rise. So stock market, as far as I understand, prefers lower interest rates. And, you know, no matter how many times you change the Federal Reserve chairman, the market still will take care of itself, because we technically still have more or less open market here. So selling in bonds, you know, it's a, at least in the long dated ones, it's a pretty significant selling here, because we're seeing an actual avoid alert or bear market for long dated ones. The intermediate ones are in caution phase, but also not great. So I will be very careful with bonds right now. Finally, let's look at the dollar DXY. So I predicted this pullback rally back in late June. I said that we're going to pull back, and basically looks like we're done with this pullback. So it looks like we're pretty much done on the 15th of July here, and we're again very close to 52-week highs for the dollar. So this pullback did not really materialize. I kept thinking that we're going to continue lower. It doesn't look like it, and especially with rising interest rates, it actually kind of makes sense for the dollar to be rallying. And of course, if since we do trade gold, gold is traded in US dollars, so gold divided by US dollar is rising, as I just showed. US dollar is in a bull market, gold is in a bear market now. Bear market for gold started right there where I'm hovering on June 10th. Why? Because it closed below this red support resistance line. For Forex-like instruments such as gold, as well as currencies, Bitcoin, we use this red and blue lines to denote bear and bull markets respectively. We see already 3 sell signals. We haven't yet seen the fourth sell signal because we need to see an actual touch of this red support resistance line. So there's a possibility next week we will touch it at least. But if we make another close below the red line, I think that will be a sign to sell for sure. So right now, with the dollar rising, gold is under pressure. I am not sure I want to be buying it right this instant. If or when dollar turns around, perhaps, maybe we'll consider gold as buying gold, but right now I do not want to touch it. If anything, I want to sell it short. And you can also sell short gold miners because they're very liquid, and potentially you could use inverse ETFs, or potentially you could use put options. Let me know if that makes sense. You can send me a message at MasterChartsTrading.com. That's it for this week's recap. Head over to MasterChartsTrading.com, click on sign up for one of the products. So again, I have 2 products in one bundle. Trading indicators are these lines in the chart, this green, blue, red, and yellow lines. They're available for TradingView.com. Once you sign up for a free TradingView account, come back to my site, Master Charts Trading, and I will open the door for you so you can see my indicators on your chart on TradingView.com. Pretty simple. Newsletters, again, I have daily alerts, and then also weekly members only videos that I send out. For today, for example, I'll be covering all of these various securities, Bitcoin, market breadths, British pound, crude oil, all of the various ETFs, large cap stocks, as well as speculative securities that we trade currently. That's a newsletter. And then best deal is to get both trading indicators and newsletters. Best deal of that is to get it on yearly subscription. You'll save 17% off or 2 months free compared to monthly subscription. All of the plans come with free 7-day trial, so you have time to try it out. Let me know if you have any questions. Again, thank you for watching. Have another great trading week. Bye-bye.